Hello, everyone. Welcome to the FTX podcast. Really glad to have here with me today Jason Choi, head of research at Spartan Group. Welcome, man.
Hey, Tristan, thanks for having me.
Yeah, it's an absolute pleasure. And, for those listeners that may not know you, would you mind giving an introduction of yourself?
Yeah, sure. I currently am the head of research at Spartan Capital, and we are a crypto asset hedge fund. And we also starting a venture strategy as well. I'm also the host of my own podcast called Block Crunch, where I speak to founders, developers, investors every single week in 40-minute deep dives into different projects and trends. And that's been going on since 2018. Personally, I've been investing in the space since late 2016 to early 2017, and I started taking the space much more seriously in early 2018. And I finally became a full-time investor in the space in late 2018.
Got it. And what got you down the blockchain cryptocurrency pathway initially?
Yeah, so I guess Bitcoin has always been on the periphery. A lot of people have been talking about it before. I read a book called The Cryptocurrency on it, and I think I started taking a look at it quite seriously in 2016 in a class, actually, a fintech class, where one of the lessons was on blockchain. So my initial interest was kind of looking at Bitcoin as a potential payment rails. I thought it was a pretty interesting idea. And then I started watching all these Vitalik videos, and I had no idea what he was talking about. So I started diving deeper in. And in 2017, when a lot of my friends started trading crypto assets, so did I. I think once you have skin in the game, you're more incentivized to learn. So I started reading everything that I can. And once I ran out of videos, ran out of white papers and blog posts to read, I decided to kind of reach out to different fund managers and investors and developers who are much smarter about this than I am to teach me. And obviously, it's not easy to get a reply from these very busy people. So I decided to start the podcast as an excuse to kind of get people to talk to me one-on-one for 40 minutes to an hour to basically give me tutorial lessons on what crypto is. And I've been doing over, I think, 110 to 120 episodes on that. And it's been a great journey so far.
Sounds like the exact same thesis of why I'm doing the podcast as well. Good.
Yeah.
Celebration for our inquisitive minds. We get to ask all the questions we want.
Exactly.
And then, so in 2017, you started trading, you got the skin in the game. What was the pathway that led you to Spartan Capital and to being head of research, and how did that all play out?
Yeah, so I guess as far as my investing experience goes, when I was in college, I was one of the Robinhood guys, trading stocks without a lot of really kind of professional analysis. And the extent of my more professional investing was as a VC, where I helped started a fund called Country Capital back at University of Pennsylvania. And the founder of the fund managed to, raise some capital from some kind of prominent tech CEO. So we were able to have that pool of capital to deploy, and I had the opportunity to help start up that arm and pen where we invested in tech companies. But it's very different from kind of trading liquid markets. I trade liquid spot markets or futures markets. And that's something that I always wanted to kind of learn more about. And the markets really fascinated me. So I wanted to kind of get more exposure on that front. So when I returned to Hong Kong after working in the States for a little bit, I was looking around at teams that were investing in crypto, but not necessarily as kind of venture capital firms, but with a more kind of flexible mandate that take into consideration the huge cyclicality of crypto markets. And one of the teams that I found was Spartan, and they were just starting out their fund back then in 2018. And the CIO of the fund, Kelvin, used to be a partner at Goldman Sachs. So he spent 20 years there and then spent 2 years at a $6 billion hedge fund called Indus Capital. And his background was something that I think is really unique in crypto at that time, where you didn't really have that many experienced fund managers or capital managers in crypto. And I really wanted exposure to that and to learn from folks like Kelvin, and to also bring in that crypto native knowledge that I garnered through kind of a year of doing that podcast. So I spoke with Kelvin and I really connected with him, and we decided to kind of join forces, and I started working at Spartan ever since then.
Sweet. And so it seems that you're just basically this inquisitiveness brought you to where you've been working ever since. Is that kind of why you ended up as head of research, or is that what you wanted to do from the beginning, or it just played into your strength?
Yeah, so I was hired initially as an investment associate, and after 8 months, I think it was evident that my interest and strength lied in kind of investment research. So they gave me the title of head of research to basically build out that arm. I brought on another person recently to kind of support us there. I think that while the title is head of research, because we're such a small team, it's actually a really entrepreneurial role. And so I get involved with considering risk management, structuring our thesis, running our venture portfolio, doing some of the hiring, and obviously some of the fund marketing stuff. It's a very dynamic role. I think the title itself, it's more of just a formality.
Yeah, that makes sense. I mean, I'm in the same position. I think that's probably one of the beauties of the space we're in. One is that easy contact to people from all these other companies within the industry. The other is that pretty much much every company in the industry is a startup still, and we get to explore so many different facets of the industry, which is pretty freaking awesome. And to go back into what your role is and stuff, I'd love to hear what interests you the most and kind of what gets you excited and how you find what you're going to dig into and research. Like, where do these tidbits come up? Because a lot of times when these companies are launching and they're, especially the really interesting ones, it's hard to get a key of where they are and what's going on.
Yeah, let me take a step back before I answer the question. So in terms of, how we decide what to look into, there's mostly two categories. So one is the liquid markets, right? So we look into anything that listed that's traded right now. And one is more on the primary side. So we look into kind of early stage investments. We try to be as early as possible in those types of investments. And those investments are typically done through kind of two different structures. The process of discovery and research for both of them are quite different. So for liquid markets, because it's such an inefficient and nascent and retail dominated space, there's not a lot of sophisticated price discovery for most of these assets. I think if you ask, 10 different funds about how they value one single asset, you probably get, 15 different answers. We focus a lot on, trying to value these assets and projecting out, 10, 20-year cash flows, especially for a lot of the DeFi assets that are generating revenue. We find that while that helps us get conviction around what the fair value should be, it doesn't really help with shorter term trading. The shorter term trading comes down to a lot of kind of trying to figure out where the space is going in the next 3 to 6 months rather than 10 to 20 years. So that's what we try to focus on the liquid fund. We try to figure out, okay, what are people going to be excited about in 3 to 6 months? What are people going to be using? What is this? How does this ripple out into other projects, right? So for instance, if we think that people are more interested in decentralized exchanges, does it mean we try to get exposure on things like synthetics? And if we think that if synthetics is going to be more popular, does it mean that it will ripple out into other layer 2 solutions that we should be looking into when people are eventually going to be looking for kind of cheaper ways and faster ways to trade in a trustless context? So that's kind of the mental process for liquid investments. And for kind of more pre-seed investments or seed investments, we typically look at teams that have a significant background in the specific domain that they're working in. So it's less important to us that these guys have traded crypto before. Obviously, having crypto native experience is paramount for the initial go-to-market, but we'd much rather see someone with a deep knowledge in that domain, because what we see from a lot of the more kind of recent DeFi projects is we have a lot of very talented developers who may lack that experience in finance. So we try to find a balance between kind of crypto nativeness and also kind of native financial understanding for the DeFi founders that we're investing in.
Mm-hmm. And sorry, I should have asked this earlier, but what would you say Spartan's investment thesis is?
Yeah, so our thesis is really generic. So we try to kind of herald the coming of an internet of value, but in terms of actual deployment, we're very specific. We think that the lowest hanging fruit right now, the thing that makes the most sense, is kind of trustless financial use cases, because that is the most logical extension of kind of trustless value transfer. So Bitcoin gave us a way to trustlessly send value across the internet. The next thing that makes sense is, what do we do with this value, right? We can lend it, we can borrow it, we can trade it, we can buy insurance on it. So that to us is kind of what we've been focusing on for the past 2 years. And I guess people started calling it DeFi as of mid 2018. But we've been kind of looking at this even before I joined Spartan. This was something that kind of interested me greatly.
Mm-hmm. And when you look at a project and you're going to present it to the team, how do you break down the analysis, or is each one different? Or do you have a structure that allows you a good lens into each of these projects?
Yeah, so it really depends on what type of project. And I think that's part of the difficulty of crypto as well, is because you have, layer ones that have very technical, low-level technical trade-offs. And you have DeFi protocols that have trade-offs on the kind of economic design front. So you almost need to be an expert at cryptography and finance to kind of correctly evaluate the entire space. And obviously no one has that background. Maybe like 1 or 2 people in the world have that background. Mm-hmm. So for us, we really try to break it down to as simple bits as possible. We try to figure out, okay, what are people going to be using? What does this mean from the user's perspective? So questions that we always ask founders we talk to is, walk us through the entire user lifecycle, right? What happens from the beginning when a user starts interacting with this app to the very end? So we want to understand what is the experience for users, whether it could get any traction with users. So that's really where we start. And then obviously we have the more crypto native parts of the research where we try to understand the incentive designs. For instance, if you look into DeFi projects, we try to figure out how are governors incentivized? Do they get any rewards for voting on specific parameters? What happens during a catastrophic event? Who is kind of on the hook to backstop the entire system? So kind of economic questions like that we also focus a lot on. One thing that I think we focus less on, or that I shouldn't say focus less on, but less of our edge is kind of the deeply kind of low level technical fronts, right? So we're not cryptographers, we're not kind of deep engineers. We don't have an edge in evaluating what different low level technical trade-offs, how that could play out in terms of value accrual. So we really lean into our connections, our developer connections, and our connections with other kind of funds to kind of share ideas there. So it's a really collaborative process, even beyond kind of the Spartan team itself.
And something I've been wondering is, I work at an exchange and the exchange industry is very competitive. Is the fund industry within the cryptocurrency space competitive, or is it more collaborative? How do you find that?
Yeah. So what I think is really interesting is I think there's always this perception that VCs are, all in it for the long term. We're going to support each other. It's a very collaborative environment. And I think by and large that's true. But then I've actually found that liquid funds, kind of liquidly trading funds, tend to be more open to sharing ideas than kind of venture strategies, especially in the recent market dynamic, given that deals are getting more competitive and funds have to really elbow their way into very good investments and very good deals. I'd say that the venture capital circles feel a little bit more competitive to me lately. At least in the short term. Whereas the liquid funds, I guess, are always kind of more open to sharing ideas just because there's so many opportunities in the space right now and the pie is still small. And I think we all recognize that and we're all trying to kind of, rely on each other for different edges.
That makes a lot of sense. And when you look at these seed, pre-seed projects, what time frame are you guys evaluating these things at?
Yeah, so I think the typical lockup for many of these private investments are, anywhere from 2 to 3 years. That doesn't mean that we sell everything in 2 to 3 years, but typically the rough kind of timeline that we have in mind is, in 3 to 5 years, do we see any type of maturity for this project? But it's hard to predict because, again, it comes back to kind of predicting longer term what is going to be the next iPhone, what is going to be the next MacBook. That's a really difficult question. So in terms of kind of our time horizon, we don't try to pinpoint a specific, say 10 years this has to play out kind of thing. So while our fund mandate for the venture fund is on the 5-year horizon, we typically don't try to kind of determine exactly what is the exact time horizon that this has to play out.
Mm-hmm. Which makes sense. I mean, even 5 years crypto is so young that 5 years is terrifying in this space. So big kudos to the, you have to have some conviction to have an outlook like that. So that's really cool. And my next question for you would be around some of the things you're really excited about. It could be specific projects or it could be the underlying technologies that are moving the space forward. Since you have such a good insight into all these things that are going on, I'd love to hear a few different things that have you excited at the moment.
Yeah, for sure. So one of the projects that I've been tracking quite closely is called Nexus Mutual. So if you look across the DeFi space right now, you have a lot of primitives that allow people to transact and deposit and earn yield on vast amounts of capital. So we started the year with, I think, under $500 million total value locked in all of DeFi. Now we're closer to 11 billion. So it's not a toy anymore, right? There's a lot of capital at stake, and it surprises me that no one has cracked the insurance model except for Nexus Mutual. So basically the thesis for Nexus is we think that there's a massive use case for insurance on all of the value locked in DeFi, especially if we expect DeFi to continue to grow. And Nexus is a very flexible human governed system where if there is, say, kind of technical exploit on, say, Compound and people lose their money, they can then file a claim on Nexus Mutual, which would then be approved by a body of human governors who are holders of the Nexus token, and they would be paid out on their claims. And in return, people who write insurance or write cover for these different protocols earn a yield. And what's interesting is lately we've also seen projects starting to incentivize people to write cover for their own project. So this new project called Keep Network, which is a cross-chain protocol that allows people to wrap Bitcoin onto Ethereum, they dedicated a part of the reward inflation to cover writers on Nexus Mutual. So if I, as a person, I want to write insurance for Nexus Cover to provide coverage for others, I would also receive incentivization from the Keep team in the form of Keep tokens. So that is a pretty powerful idea where we see kind of, it's pretty amazing that it's compared to kind of Web 2.0. You have all these open protocols where people can just plug into each other without permission. I, as a kind of not so technical developer, I can probably come in and try to hack together a couple of existing protocols and rely on the work that's done by all these other great founders already. I can't guarantee that anyone will use it because I'm a terrible coder, but at least there's a possibility of doing that, right? I can build things using these different Lego pieces. So I guess that's why people call them kind of DeFi Lego pieces, right?
Yeah, and just like how involved the communities have been getting with so many of these projects. It's incredible. It just really shows that when you open source the code and you let the people get involved, there's so much conviction that these people hold for the projects that they really like that they end up making the projects better themselves. Like for me personally, a big telltale sign of a project since this whole DeFi boom started that's going to do well or not do well has been the community and how involved they are, even in a tech, not, obviously there's the marketing aspect and the shilling and whatnot, but from the technical aspect too, which I think is really important.
Yeah, I think community is probably the most important mode, right? Exactly because of what you said, where all of these protocols are open, they can be forked. There's no real mode to liquidity. We've seen that play out with all these kind of yield farms in the past month or so, where you have something that tries to steal liquidity from an incumbent by offering artificial rewards. And in the initial days, we would see maybe hundreds of millions of dollars deposited in these challenger protocols. But then once the rewards leave, the liquidity leaves as well. So there's not a loyalty in liquidity. There's not a lot of defensibility in tech. So it really comes down to how good of a community, how dedicated of a community can you build? And that, I think, is the much harder thing to crack.
That makes sense. And I'd love to keep hearing projects. So the first one was Nexus Mutual. Which other ones are exciting for you?
Yeah, one that I'm quite excited about as well is Wi-Fi, but I suppose that's been talked to death by a lot of people already. But for those of you guys on the show who are not familiar, Wi-Fi is the native token of a project called Y-Earn Finance, and it's basically a yield aggregator. So as you know, there are so many different DeFi protocols and so many different ways to generate a return on your capital right now. You can be lending out your capital on Aave, on Compound. You could be providing your capital as liquidity on decentralized exchanges like Uniswap. So what Y-Earn Finance does is automate a lot of these strategies. So basically you put your capital, you put your ETH in a vault, and the vault will automatically kind of allocate your capital to whichever strategy is earning the most yield in real time. So the Wi-Fi token earns part of the performance fee generated on some of these strategies, and it's also used for governance purposes. So the way I think about it is almost like a robo-advisor for crypto. Think of Wealthfront, but on a trustless context. So that to me is a pretty powerful idea as well. If you think about the sheer amount of capital that Wealthfront is controlling and the kind of ability to abstract a lot of the complexity we see in DeFi today. I think that's a pretty powerful concept. And going back to the point about users, from a user perspective, it's also incredibly easy to use. You don't have to interface with 10, 20 different protocols. All you have to do is go to this one place and you can get access to most of the kind of yield strategies in DeFi today.
Yeah, I've heard a lot about Wi-Fi. One thing that I think a lot of people haven't had a good reflection on is the purpose of the actual Wi-Fi coin. Would you mind shedding some light on that?
Yeah, so what the Wi-Fi coin does right now is mostly for governance purposes, right? Because it was launched as a fair launch coin, which means there's no VC allocation. Folks like Spartan couldn't have had a significant advantage over the average retail guy because it was distributed completely kind of decentrally. Even the founder didn't have an allocation. So if you don't have a team that has a massive treasury, how do you incentivize any entity to kind of go to work on this thing? You would need to coordinate kind of massive action. You need to coordinate governance from day one, just because you don't have a controlling state as the founder of the project. So to do that, you need to incentivize people to use the token to vote. And the way that Y-Earn Finance is doing this is by offering a fee to Wi-Fi holders. So if you participate in governance, then you get a cut of the fees generated under the platform. And currently the fee comes from two things. So one is the exit fee for default, right? So if you deposit money, it's free of charge. But when you decide to redeem your capital, then you do have a little bit of a redemption fee, which is I think 50 basis points. Actually, no, 5 basis points. And there's also the performance fee, which is the small cut of the profits that you generate on the strategies that your capital is deployed into. So in short, the Wi-Fi token grants people the right to govern the protocol, and in return, it gives them a cut of the fees generated on their protocol. So it's not dissimilar to equity, but I also am hesitant to use that word just because there is no company, there is no entity there. So it's not exactly equity.
Okay, that makes sense. Thanks for the explanation. What do you think is happening right now with the market? I mean, we've seen iteration after iteration after iteration after iteration of all these yield incentive schemes, and there's been so many now. It's like people are just, it's not that they don't even want to get into them. There's just so many that they just have fatigue, I think, and can't keep up with everything going on. What do you think is going to sort of evolve out of this? Are the strong projects going to be the winners and come out in front? Is this going to continue? Are we going to have a DeFi bear market? What's your personal feeling here?
Yeah, so here's the thing. I think a lot of the yield farmers mentality is not dissimilar to the Chinese retail mentality back in 2017, where you know a lot of these things are probably unsustainable, and some of them might be kind of straight out scams, but the average yield farmer thinks they can get out before the next guy. So it's kind of the greater fool theory. So I think a lot of that is noise, right? The things you see with 500,000% APYs and these different farms, I think that's ridiculous. That's obviously not sustainable. And we have seen those yields start to collapse in the past 3 weeks because a lot of the yields are denominated in the native kind of governance token for a lot of these projects. So once the speculation on those tokens come down, the yields will come down. So we do see a collapse of the yields. I do think that will continue. Will we still see kind of 100,000% yields? Maybe, but I don't think that's sustainable. It's probably a flash in the pan for a lot of these high yields. And what we've seen recently in the past 2 weeks is a flight to quality, right? Because Uniswap just launched their liquidity mining program. And as you know, they are the most liquid decentralized AMM exchange today. They generated as much volume as Coinbase on some days. And even though their returns for yield mining for yield farming significantly lower than a lot of the other farms, they're promising maybe 20 to 30% in the uni tokens compared to say, 100% or 1,000% in some of these newer farms. They do lock up 10 to 20x more capital than the next farm. So on the wrapped ETH, wrapped BTC pool alone, I think they have almost $500 million of tokens locked up compared to, I don't know, something like a Percent, which is a newer project, which has single digit million in terms of total value locked. I do think that people will start to be more discretionary and start to kind of flock to more quality projects, more quality farms. You still get your mercenary farmer going after the 100,000% APY, but I do think that a lot of the projects with a strong moat in terms of the community and the technology and the brand and the trustworthiness will start to siphon a lot of the liquidity out from these degen farms and start to own a lot of the liquidity.
So something I've been thinking about is how these yield incentives, yes, they have brought a ton of attention and capital into this space and into these projects, but do you think it's spoiled us all rotten in the aspect that now if an incredible project comes out without one of these, that they'll just be overlooked and forgotten? Or do you think people are still discerning enough to pick them out?
Yeah, so that's a great question because I think that cocks back a little bit. I think what really started this whole yield farming craze was Compound. So obviously synthetics did a little bit of that before, but we didn't really see this massive explosion of yield farms until Compound, a kind of leading project in terms of liquidity, in terms of usage, issued their own token through a liquidity mining scheme and inspired all these other projects to do the same. So I do think to a certain extent, if you have a project today and you're launching with a hugely centralized token ownership, token allocation, where the VCs and the founders own most of the tokens, you would introduce, I guess, some bad faith, or at least compared to some of the fair launch projects. And you do see a lot of projects try to capitalize on this, right? So Curve has a VC allocation. So that's why we saw Swerve, which is an opportunistic fork that has no VC allocation, basically fairly distributing all the coins. Uniswap, I guess, is Sushi, and you guys would know since you guys are running the show right now. And a lot of the other projects also have these kind of no VC, kind of no founder allocation liquidity mining programs. I do think that has a certain amount of attraction for some users, but I don't think it's as important as people think, because in the long term, people will just use whatever is the cheapest, whatever is the easiest to use, and not necessarily what is the least owned by VCs. And in the long term as well, where most of the VCs intend to sell their tokens based on this idea of progressive decentralization, where most of the projects are trying to actually diversify their holder base over the long term. So I'm not sure how much of a moat these kind of community-focused forks will have in a longer term basis, but I do think that it's inspiring a lot of projects to think about these problems.
Mm-hmm. My next question is a bit of a pivot from what we've been speaking about, but considering what occurred today with BitMEX, and we're starting to see this regulatory oversight being active again in the space, which has seemed quite nascent for some time, how do you think this is going to affect some of these decentralized protocols? And I think specifically the best example for this is Uniswap, just because their team is in the US and they just had this huge airdrop. Are you guys at Spartan concerned about things like this, or do you think it'll be fine?
Yeah, so I think the BitMEX situation is a little bit unique in that I think there were a few quotes that were pretty, how do you say this?
Damning.
A few quotes that were pretty damning, pretty provocative. So I think it might be a special situation. And BitMEX is also facilitating, multiples of volume compared to something like Uniswap. So I don't know if that situation is applicable to a lot of the DeFi exchanges. So my initial knee-jerk reaction is, and obviously this happened, less than 12 hours ago, so we still need some time to kind of digest this, but our initial knee-jerk reaction is this should be good for DeFi, because this is exactly what DeFi is for. You want to have, decentralized and entity-less kind of products which don't really have the same type of, baggage that a lot of centralized exchanges have. So our concern is more on the centralized exchanges front, especially those that don't have very stringent KYC processes, that have, that we know have been servicing US customers very likely. So we're more concerned about those exchanges. In terms of decentralized exchanges, I think it's probably going to be in the regulators' purview, but I don't see them coming after the DEXs anytime soon. If anything, it's probably going to be at least a year or two before they start looking into this, but I could be completely wrong on that.
Yeah, I think I'm not sure, honestly. I think you could be right just from the perspective of I've been thinking DYDX was going to get in trouble for so long now and nothing has happened. I don't know if it's like the whole laissez-faire attitude towards these people are building things that may overall be very good for the economy as a whole. So maybe we have to keep letting them build. I'm not quite sure what the rationale is behind it. I think in a lot of ways, we're entering a very interesting phase of the market and of cryptocurrency and blockchain in general. So I don't think this will be the only excitement we'll see in the in the upcoming year in this space is my prediction on this. We'll see what happens.
Yeah, and I think a lot of that also comes down to size, right? I think the SEC and CFTC, they're not going to go after DYDX because I think they're facilitating maybe, under $5 million in 24-hour trading volume. So they're not going to go after something unless they know it's going to be a kind of big win for them. So BitMEX, we're talking about billions of dollars. So it kind of makes sense there. So I think from a scale perspective alone, DeFi is not quite there yet for, CFTC and SEC to start worrying. I think the general consensus is that by the time it gets there, it will be decentralized enough that there's not really anyone you can go after. It's just going to be a completely trustless entity. And by then, how would someone like a CFTC go after a completely decentralized protocol that's owned by people all around the world? I think there will be new kind of regulation frameworks needed for something like that. And I don't think we're going to see that, within the next year or so. So we're not too concerned about that.
Oh, fair enough. And then my last question for you, Jason, is you guys are at the forefront of meeting many teams of builders in the space. You have the choice of investing or not investing in a project. You have a lot of insight into all these things. What are some words you could leave with listeners that may want to build or found something in this space that would also attract attention from groups like yours?
Yeah. So I think lately we've seen a lot of people start to build things that are more provincial. So things that solve problem within DeFi itself. I'd say that is not a direction that we want to see because as, long-term investors, as VCs, you look at total addressable market. You want to see how big this market could be. So if your product is mostly focusing on, say, providing liquidity specifically for kind of decentralized perpetual swaps, that's a very, very niche market. So you could make the argument that, in 10 years, the whole DeFi space is going to grow. That's why our product's going to have a massive addressable market. But that typically is a hard sell for, I think, investors in this space. What you want is to tackle a problem that's large enough in a market that's large enough to make it interesting. So I'd say as a general kind of advice or as a general kind of aphorism, thinking big never hurts anyone. And I think especially in crypto, we should start to look outward and not just create games for kind of DeFi whales or crypto whales, but also think about how do we build things that the average Joe can use, because that's how you get to the massive market scale.
Yeah, that makes a lot of sense. And I really appreciate your time, Jason. Thanks for coming on and chatting with me.
Yeah, absolutely. Thanks for having me. This was really fun.
Take care.
All right, take care.